Hi, everyone, and welcome to another Facebook Live. I'm Megan Brenneman. I'm here with Megan Galane, and we're very excited to talk with you today about the philosophy of wealth building. So we're kind of jump in a little bit right now, but we're very excited to have you joining us today. Just remember to like, comment, and share. And if you have any questions about your self-directed IRA needs, feel free to give us a call, the number 866-377-3311. So Megan, kind of what are we going to be talking a little bit more about today?
Yes, let's get into wealth building. So if you have any questions along these slides, go ahead and add them in the comments section. We can answer right away. So it's the easiest way to continue the conversation and ask questions. But let's just get started on the philosophy of wealth building. So let's see if I can get the slides to work. Just as a quick disclaimer, Mountain West IRA does not offer tax, financial, investment, or legal advice to clients. We do not promote, endorse, or offer any investments, and individuals who believe they need advice should consult with the appropriate professionals licensed in that area. You can always ask us questions and we will point you in the right direction, whatever that may be. So just feel free to always ask us, and let's jump into the philosophy of wealth building. So wealth building your money, building your wealth is something that I believe we're all trying to work on, right? We're all trying to figure out the best way. We're all trying to figure out the new innovative ways with what's going on in the economy. It's kind of one of those times where we're like, okay, what happens? So this is really just the basic building blocks of wealth building. We are not getting into specific strategies or investment strategies or anything like that. It's really just the basics, but let's jump in. So living. First, you always have to determine what your financial needs are on an ongoing basis. So what is your budget? What would it take for you to live comfortably every single month? Have your bills met every month? And don't forget your taxes. You always have to pay those too. Income received is subject to income tax, which can be significant. And this will cut into what you do have time to invest with. Let me get rid of this banner so you can see the bottom. This is the first step you would take in creating your budget. So as a budget tool that I like to suggest for if you have not created a budget, I use Mint, like mint.com. It's an app on your phone as well. I think it's a great free tool for people to use to create a budget, keep track of their money, and really start to determine what they need to live. And they do have a budget software tied into it. So you can write down your budget, and then it just loads on your phone, and it's, green's good, yellow's getting close to the end of the budget, and red, you're past your budget. So it's a very simple tool to use.
It's very simple app to use too. Something that we talked about in one of our training, Megan actually had our entire team download and do it, and something that I've used. So it's actually a great tool and it's very easy to use. So if you need more or want more information about it, let us know too.
Yeah, that's not like we don't get paid to promote it or
nothing like that.
It's literally something I've been using since college, around the time when it came out, and it's just helped me just learn about money, where my money is going, creating a budget and stuff like that, and creating a budget in like the new age, not like having to take cash out or trying to figure out what's going on. Like we get to actually use our cards, be able to see where the money is going, and it's a pretty cool tool, and it's free. That's what I like about it too. So it's free. So
it's definitely different than an Excel sheet that I used to use.
Yeah, very different than Excel. So to live, begin your wealth building by finding a way to generate the income that you need to live comfortably, and you can accomplish this by working for someone else or yourself. So whatever you're doing right now, you can, either way, creating a budget that works for you. This is just the first foundational step of what it takes to build wealth. You have to know that you're spending less than you are making so that you can actually start taking the money that you are making, the extra money, and start to replace yourself, replace your income by investing. So the next is to replace your income based on the hours worked with the income that is automatic. So to create a passive income flow. What is passive income? So that's income that's coming to you without you having to spend hours working on something, like coming to work, or in your business, if you're a consultant or something, or a real estate investor, you actually showing up. So passive income looks kind of like rental income, no income. You could potentially invest in private companies. That can be passive income as well. So it's really what you're familiar with. And that's one of the benefits of investing with a self-directed IRA, because you get to choose what you want to invest with. And so this is the second step of the philosophy of wealth building, is replacing your actual income. So this must actually equal or exceed your current working income, and requires the goal is that it requires much less effort to maintain. Once in a place you're financially independent, you can quit your job, free up time to truly start wealth building. And we say this, but I want to say it in an also lighter term, that you don't have to quit your job. I feel like when we talk about wealth building, we talk about people always leaving their jobs and either having so much passive income that they don't work, they just continue to invest, which is great. That's some people's life. Some people love what they do, and some people love working and have the ability to actually create a second stream of passive income while they work, and just continue growing that nest egg where they are able to build generational wealth forever. So the passive income does equal financially independent. Now, the third part of philosophy wealth building is to actually build. So building, there are three forms of income when you're building: immediate income, which is like your present income, your cash flow over time, and your future cash. Once you have achieved a cash flow, which meets your monthly needs, each additional dollar is taxed, leaving only the after-tax amount to invest. One of the best ways to build at this point is to use your IRA to invest in real estate, promissory notes, private placements, and all other forms of assets. If this is a Roth IRA, so if you're investing in a Roth IRA, then qualified distributions will never be taxed again. If you've missed some of our other lives, a Roth IRA is where you pay taxes on the seed, but not the tree. So you're getting taxed current year, but you continuously get to build and invest and use that money over and over and over again for it to be this big tree. And you don't get taxed on the big tree because you already paid taxes. The IRS is not worried about you having to pay taxes later down the road. They got their money, they're good. And so now you get to build that freely and take a distribution once you're 59 and a half, or if you had the Roth IRA open for 5 years, whichever comes later. But the Roth IRA is a great way to invest. Roth IRA is one of my favorite accounts. I have my money in a Roth, and the reason being because the goal is to always make more money and retire with more money than I'm making currently. So that's why it's super important to start actually building your income during the wealth building phase.
Yes, and I did want to bring up, if you are not eligible for a Roth account, we do have options that you can do with the conversion, with opening a traditional and going that route if you're wanting to. That is a taxable event, but if you want more information about that, because there are income limits for a Roth IRA. So keep that in mind. But please, if you have any questions, let us know. It looks like we might have a question.
Yes, and it's called a backdoor conversion.
Yes.
Hi, Cherish. So then to continue to build, so the structure investments to produce minimal additional immediate income. Seek to keep additional investment dollars tax deferred if possible and current tax income tax advantage. This is a lot of tax information. I understand that we aren't CPAs. You always want to make sure you're talking to your CPA or financial planner, accountant, when it comes to what taxes work for you and how you can tax shelter the most of your money, or more money, tax shelter the more money, more possibilities for you to invest. So I will get to your question about SEPs. So the structuring your investments, they could produce like the minimal additional immediate income that will be taxed. Rather, you will seek to keep the money invested tax deferred if possible, and any income. Okay, I said this. Just want to make sure. I wrote notes for myself, guys. I got a little nervous. This is the first time we presented this one. So capitalism works. You always give people more than you take. And the reason that giving people more than you actually take is why capitalism works. And the current society and how I feel like it's getting looked at now, capitalism is getting looked at as evil. And the reason it's getting looked at as evil is because people are taking more than they give. So when we break it down, what real capitalism is giving and then taking less than you give. So it works in an essence, except it doesn't work when people get greedy. So
Right.
I'll just say that. So the absence of cohesion, I can never say that word, cohesion. People always get more than they give up, or else they wouldn't do the deal. Nobody wants to do a deal and be in the red or lose money in a deal. So that's the reason why it doesn't work when people get greedy with capitalism. You have to give more than you take. So high income does not equal rich. This is something we have been programmed to believe, that if you are rich, then you are wealthy. Or if like a doctor, we have this idea that doctors make a ton of money and so they're rich, but realistically they're not building wealth. Many times they're don't have their budget under control. They are living still paycheck to paycheck, just at a higher income area, at a higher income rate. So rich is not always, or high income is not always rich. I like to say wealthy. I feel like rich still gives a term of like,
I do like that.
like you're living that rich life and it's like spending just as much as you make. And that's not the goal. The goal is to become wealthy in a sense where you can actually accumulate assets so that you can build wealth, generational wealth. Yes, exactly. High income earners and still broke. And that happens so often because when you make more money, you want to go spend more money, buy that purse, buy that thing, buy the house, buy the boat, all that stuff, because now you make the money and you're still living paycheck to paycheck. So the dream is possible to replace yourself with capital and assets. Our clients normally have the dream, set the goals, make the plans, create the budget, acquire assets, and start implementing. So enough assets creating predictable income equals freedom. And right now with everything going on, we understand that like the rental, it may seem kind of scary to get into like a rental market or becoming a landlord at this moment. And it's because of rents not getting paid and stuff like that. I'm in a ton of real estate groups, and they say that they're not having issues, and they're not having issues because people need a place to live. And although evictions have been getting pushed off in many states, people still want to make sure they have a place to live at the end of all this. So it's just knowing that real estate, owning the actual land, is super important. We get taught that stocks and mutual funds are the way to go. However, you're not owning anything. Like it seems like really dark to say this, but like if we're at this stage where everything shuts down, like we have been, but now corporations start shutting down, you're losing money in stocks and mutual funds. Your real estate assets, even in a real estate market, let's say we go through a real estate crash, you're still going to have the land. The land does not disappear. So that is why our clients like to create this wealth building strategy within their plan, within their retirement accounts, including their retirement accounts. That's just a section of the wealth building tools, but they are able to actually accumulate hard assets that they know and understand within retirement accounts. And that's just why self-directed IRA works. So we like to offer service through education. And okay, so I want to hit some questions. Megan, did you want to add anything to that?
I did want to add something because I do feel like it's so important. I mean, I feel like more now than ever, clients are calling and asking questions about diversifying their portfolios. And one of the biggest things right now is, I keep telling them, this is a physical asset that you have, that you own in your IRA. You never know what's going to happen with the stock market. We don't know, but there's that physical asset. Now, we're not saying, pull everything out. You can have a little bit of everything. So that's the thing to keep in mind, is diversifying your portfolio.
I would agree so much with that. Diversification is so important. Okay, so Cherish, I want to talk about steps for the self-employed friends. So I will send you the link to an individual K video. So I actually prefer individual K accounts over SEP accounts, and I'm going to tell you why. So the SEP account, let me get my little cheat sheet really quickly on the contribution limits so I don't mess this up. Meg, do you have that handy?
I do.
Can you do a screen share with that?
I sure can.
Thank you. So the SEP is an account for the self-employed individuals. However, you have to earn quite a bit of money in order to actually max it out. And it acts like a traditional IRA in the sense of it grows tax deferred. So tax deferred, you're getting the write-off current year, and for the high net worth, high income earners, they think that they want this write-off, which is possible. They may want the write-off. And when they do the write-off, then they are able to contribute into the SEP, and the SEP at that point, they can choose to diversify, invest. They want to do self-directed, they can. So you can see, can you zoom in a little bit on just the contribution limit part? So you can see here this SEP is 25% of compensation with a max of $57,000. So you have to earn quite a bit for 25% of your income to be added into that account. And then it works as similar to the traditional, where it's a tax write-off, but then you get taxed later on down the road. So you do have a required minimum distribution because the IRS wants their money at some point. They gave you the benefit of a break at this current year. So later down the road, they want their share. So they said, I gave you a break later, years ago, but so it's our turn now. So you have to take a distribution. If you don't take the distribution, they'll force you to take it, and it will be way more than you really want to take. So for my self-employed individuals, I really always suggest for them to look at a 401k. So it's called an individual K plan or a solo K. It has all different names, but so we call it an individual K plan. And the reason I like to tell people to look at this as the self-employed individuals. So there's two ways to contribute to this plan. The employer contribution, so you are the company, so your employer, your company, contributes 25% of compensation with a max of $37,500. So your business then gets a write-off of $37,500. So that's the traditional portion. Then you can make a lot less to max that out. Then you have the employee portion. So the employee, you are the employee of your business. The employee person under the age of 50 can contribute up to 100% of their income, up to $19,500. So if your tax accountant or whomever you're working with says that we're not going to pay you, and with a SEP, you don't have to get paid. But with a 401k, if they were to pay you $19,500, you can put that right into the traditional portion of a 401k or the Roth portion. You can pay taxes on that $19,500 current year and grow that portion of your retirement as tax-free forever. So the 401k is what I really like to have people look at as they're self-employed, because you can make less and contribute the same amount as you could with a SEP. Now, in addition to that, the 401k has a benefit where you can actually take loans out. So let's say you had a personal loan, Corona happened, this happened, and the business was bad and you needed a loan to sustain your business and your current house. So you can actually take a personal loan from your 401k plan, just like you could a corporate 401k plan, and then you can pay yourself back. You could take that loan for any reason. You can take it for investment purposes if you didn't want to invest in something inside of your 401k, which you can totally do, but you can also take it to pay your bills if you need to. So it has more freedoms in addition to like checkbook control and other investment freedoms. The 401k, the solo 401k, individual K, works just like a corporate 401k, but it's yours. And so you can also have it for your children. If your children are employed by your business, you can open up a 401k for each one of them. And they would also, if you were to max out your employer plan at 25%, let's say you max it out at $37,500 for yourself, you could then max that out for each one of your children. And then on top of that, if they get paid $19,500, you can max out each one of their plans at $19,500. And so you can see here the freedoms with the 401k. It gives you just a lot more diversification in how to store away money and get it in tax sheltered accounts really quickly. But then on top of that, it works just like a self-directed when you have it through us, where you can invest in real estate, promissory notes, private placements, precious metals. It goes as crazy as cows and airplane hangars here. So it's really up to you. And I have a whole webinar. I will add the link underneath the comments here to go where I could share more information about 401ks. I believe we have like 1 or 2 webinars on it. Yeah. So I'll share those here. And yeah, so the 401ks are actually who I like to share for my self-employed friends. But, oh, one more thing. So then the employee portion, let's say you only want tax write-offs. So you can make less money with a 401k, max out the 37.5 and the 19.5, and you can make less money and put it both in traditional accounts. And so you're then have the same write-off but making less money than you would with a SEP. So that was, if you have questions on that, let me know. I'm happy to talk about this more. But these are all like wealth building strategies on how you can actually use your retirement account to accumulate wealth. And I'm going to say this in the nicest terms, you can also use your children who work for you, right? They need to work for you. You can use your children and start accumulating wealth. I think we have a client who, our youngest client ever was 1 year old. She's now, I think, 3 years old now. She's a sibling that when he was 1 year old, he got an account, and the father every single year for their birthdays would put money into that account. So it's not just sitting there, because he actually takes that money and partners each of their accounts with his own IRA and invests the money. So these 1 year olds own a percentage of a house within their retirement accounts, that the retirement account at their Roth IRAs. So at their let's say they're 18 and want to go to college, their college can be completely paid for as a distribution from the Roth IRA, and they never have to worry about it. Or let's say they keep investing it, and they go to college on scholarship or something, and they don't have to pay for anything, or if they do, they paid out of pocket. Then they graduate college and want to purchase their first house. In a Roth IRA, you can take a distribution for a first-time home purchase. So these, like, the IRAs are just quite like a wealth building tool that you can use in so many different versatile ways. And the families that we see, that the parents that are opening the accounts and sharing, like, it's not that it's their wealth. The parents still get to control the accounts. I mean, we had 18-year-olds, their parents still controlled their accounts, and they're using it for investments. But it's the opportunity to put wealth away in tax sheltered accounts that's protected, and the parents can control, even when, like, they really, like, at 18, 21, let's say, like, the parents can still control the accounts. So it just kind of works for everyone as a wealth building tool. And they don't have to, have everything 100% within the IRA. So I think we have our most partnered, like, with the most, like, children. So it's actually like the grandparents, their children, and their children's children. And I think we're at like seven to nine. It's like on one property of different people, because their IRAs are all with us. The IRA, so we separate the checks in-house. We did all the paperwork for each account. Yes, they have fees for every account, but they are building wealth in these multiple accounts. So it's a wealth building tool that many families use. Up to 10,000 distribution for first-time home buyers. Yes. Yeah, that's right. So, yeah. Any other questions? This was a great conversation. Thanks for checking in.
Yes, it was great.
Yes. Okay. So I'm going to put up our phone number. So if you want to call us with more questions, so contact us at 866-377-3311. Megan B, or I'm Megan G. So you can contact us, Bianca, Diana. We can help you out with any of the questions we've talked about here. I will share the link with the YouTube channel so you can get more. If you want more videos like this, they're easier to find on our YouTube channel than scrolling through our page on our Facebook page. But I'll share that link down below. And then if you have any other questions, contact us at accounts@nwira.com, and we will let you answer. We'll answer you. Ask your questions away. We're not attorneys. We don't charge for this information. Ask your questions, and we can see if somehow a self-directed IRA may be right for you. So thanks for joining us today.
Yes. Thank you, everyone. Have a wonderful day.
Bye.
Bye.